Hi everyone, welcome back to I'm No Expert, but Finance. Today we're diving into a growing shift that's changing the business world. More and more major companies are leaving China. Big names like Macy's, Walmart, and even Shein are quietly pulling their sourcing and manufacturing out of China. But why? And what does this mean for global trade and for long-term investors like us? Let's break it down. How China became the world's factory. For the past 3 decades, China earned the title of the world's factory. It had all the right ingredients such as low wages, huge labor force, and strong infrastructure. Global brands rushed in to build, source, and scale. From iPhones to shoes to fashion, if you bought it, there's a good chance it came from China. But the conditions that made China so attractive are shifting. First off, costs are rising a lot. Wages in China have more than doubled in the past decade. Cities like Shenzhen and Shanghai now have labor costs close to Eastern Europe. That's a huge blow for retailers with thin margins. And it's not just wages. Land, electricity, shipping, and regulation costs are all going up. The price advantage that once made China unbeatable is shrinking fast. Another big reason companies are leaving? Risk. The US and China trade war added tariffs to billions in goods, forcing brands to rethink their reliance on China. Tech bans, sanctions, and political pressure are adding uncertainty. What if the US blocks Chinese exports again? What if China retaliates? Businesses hate uncertainty, and many are choosing to leave before the next disruption hits. COVID lesson and China plus one strategy. Factory shutdowns during COVID and shipping delays. COVID-19 exposed how fragile global supply chains are. When Chinese ports shut down, the ripple effects were massive, from iPhone delays to toy shortages. That led to the China plus one strategy. Keep some operations in China, but add a second base, such as like Vietnam, India, or Mexico. It's all about reducing dependency. So where are these companies moving? Shein is shifting manufacturing to India, partnering with Reliance Retail. Macy's is expanding sourcing from Vietnam and Bangladesh. Walmart is investing in Mexico for nearshoring closer to U.S. markets. These countries offer lower costs, fewer political risks, and growing infrastructure. And unlike 10 years ago, these nations are now ready for high-volume production. What does this mean for investors? Let's talk about what this shift means for us as investors. Companies that diversify their supply chains, moving beyond just China, are generally more resilient. That means they're better prepared to handle disruptions like trade wars or lockdowns. Just look at this chart. Diversified supply chain companies score around 85% in resilience, while China-reliant companies drop to around 50%. But it's not all one-sided. China-reliant firms still lead in cost efficiency around 80%, while diversified companies average closer to 60% due to new setup costs or smaller scale. So the trade-off is clear: resilience versus efficiency. As long-term investors, we might favor the safer, more flexible companies, especially in a world of constant shocks and change. So more companies are quietly pulling out of China. Why? Because the costs are up, the risks are rising, and the world is shifting toward resilience and diversification. For investors, this trend isn't just about factories. It's about how smart companies adapt and how we should pay attention to the ones that do. If you found this helpful, please like, subscribe, and leave a comment. This is I'm No Expert, but Finance, and I'll see you in the next one.